Hello everyone. Today we are going to discuss capital markets and the pricing of risk. So we'll first look at the risk and return from a historical perspective. Then we'll look at how to measure or calculate risk and returns. We have two types of calculations. One is based on historical returns. The other is based on expected future returns. And we will look at historical trade-off between risk and return. In the next four topics, we will look at the systematic risk versus independent risk, and the diversifications, how to diversify away the independent risks using portfolios. And we will look at how to measure systematic risk. Specifically, we will look at beta. So the first question is, if we invested $100 in the market, so this type of assets for in 1925, how much are we going to have after 92 years? Let's first rank this based on its riskiness. So this is the safest, right? And this is a second safe, and this is a third, and this is a fourth, this is fifth, right? And let's look at the return profile. So here, the lower one, the purple line, is the inflation. So if we have studied the present value of time value of money, you could say PV equal to 100, FV equal to 1378, and N equal to 92 years, and there's nothing payment in the middle. So what is your investment return? So what's the rate of return? You can do that calculation. Okay, do that calculation. So it's really just if we look at here, it's FV equal to PV 1 plus R raised to the power of 92, right? So here it's 1378 divided by 100, right? So this divided this side, and this is equal to 1 plus R. If we are going to take a log, so this is going to be log return, okay? And you have 92 here, so you divide it by 92. And here you have one unknown, we can calculate the return, okay? So how about do that calculation? Let's do that in Excel, okay? So here's the we have the PV. So we have a PV FV, we have N, we have payment, and we have the rate of return, okay, annualized. So this is really negative 100, you invest, and then you get to 1378, and here 92, and here's 0, and this is really just rate of return, 92, and the payment, PV, and then you get to future value. So the return is about 3%. Okay. So about 3%. And we could simply easily do a calculation for Treasury bills, 2063. So 20. So this is 2063. And the return is 3.34%. So for T-bills. And similarly, we can do for others. Let's do it for SP 500, 664,567. So 10% for SP 500. Okay. So here's a CPI. Here's a T-bill. Here is a SP 500. So what is a small stock? So here, small stocks, any guess? This is a 5792. 572. I think it's a 25%. Nope, not even that. Just 12.66%. Okay. So if you look at because of this compounding effect for a long time, for 92 years, even the 2.5% every year make a huge difference. Okay, make a huge difference. You would think on nominal terms, these are really high, but then you look at the on the return basis, it's these are the numbers. Okay. So I would encourage you to practice these calculations yourself. And if you look at this, you can do another way as well. Okay. So suppose you go from here, go from 100 to this one by this rate. See how much you can get. Okay, let's say equal to 100 times return. Let's say this is return to the power of 92. Okay, so that's the number we are getting at. Okay, so if you somehow have any doubt on whether this is right or wrong, we just reverse engineered this number and it's correct. Okay. Okay, next. We obviously have looked at which ones have higher returns, which ones have lower returns, and it correlates pretty good with the riskiness of the asset class. But very few people make investment for 92 years. So we have to be realistic. How about for a 10-year time horizon, 20-year time horizon? So if we look at this chart, the first chart, look at the A, 1 year. 1 year, you see if you have this line across 100, across this vertical axis, then there's a pretty good chance you have a negative return, a drop below $100. So that means you lose your part of your principal. And when the horizon widens to 5 years, the chance of losing is much lower, but still some significant losses possible. For 10 years, rarely you lose, and for 20 years, you really don't have much chance of losing money, lose your principal. So if you are investing for the long term, you are better off by investing in higher risk classes. So how do we measure risk? Risk has to do with something about the future. When we talk about future, it's mostly about probabilities. So essentially, we'll look at all possible returns, And for each possible return, we look at the probability. And then we have a plot. Okay, that's what we call the return distribution. But rarely we'll have identified all of the possible returns. Instead, we are going to have just a few scenarios. In this case, we will look at 3 scenarios. So there's a chance you hit a very good return. And there's a pretty good chance you have just a 10% return. So we'll look at how to get this 10%. And there's a chance you are going to lose money. So we can, based on this information, we can plot to plot the probability distribution or the return distributions. So if we plot the return on the x-axis, so here we have the return, and y if we have the probability. So return high and probability high is 25%, and then you have another return at 10%, another return at a loss. So that's a probability distribution, just like what we have here. And here we calculated the return from 100 to 140. So 140 minus 100 divided by 100 is 0.4 or 40%. You get this number. Similarly, 100 to 110, you get 10%. And here you lose 20%. And these are the probabilities. If we multiply probability with return, you get a probability weighted return or the expected return. In this case, it's 10%. And you can do this in Excel by using the sum product function. So in that, you have the probability array goes to the first argument, and the range for the returns goes to the second argument. And there's really not much good measure of risk. So most people in the market use variance or standard deviation returns as a proxy for risk. And these terms are borrowed from the statistics. And variance is the deviation from the mean, squared and multiplied by the probability. So if there are n terms, for example, if they equally distributed, each p will be 1 over n, right? So that's why where you see the return, the variance is something like this. Okay. And standard deviation is the square root of variance. And you take the return, square it, and square root it, so the unit still return. So this standard deviation has the same unit as the return. So it's widely used. We also call this a standard deviation. In finance terms, it's called volatility. And here we have one example. So probability and the deviation squared, probability deviation squared plus together, you get a variance. So there's a percent sign there. Okay. And take the square root, you get this number. And the mean of standard deviation, typically we look at 2 standard deviations, for example, from the mean. So if the mean is 20%, so 2 standard deviation would be roughly 40% below mean, so negative 20%, or 40% above. So this is a range of 95% confidence. okay, will fall within this range. So that's an interpretation of standard deviation or the volatility. So here's another problem. So equal likely. So that means if you have two returns, it's 50% each. If three returns, it's 1/3. If five scenarios, 1/5, etc. If n, it's 1/n. Okay. So what is the expected return and volatility? So simply you have two scenarios, P times return, P return, and together. So that's a expected return. And the variance is a probability weighted. You have probability. Remember, don't square the probability, okay? But you square the deviation. Okay? So that's a variance. And apparently, there is a percent sign there. And then you square root it. You get the standard deviation or the volatility, 35%. So two standard deviations would be 80% or negative 60%, right? So we have these two distributions, the red and the blue. Which one is riskier? So we would say the red has a wider distribution. So red investment, AMC is riskier, whereas the blue is less risky. The next topic is to look at historical returns for stocks and bonds. For stocks, there are two components. One is the dividend. The other is this is called a dividend yield. And here is what we call capital gain yield. And the return would be the sum of these two components. And if we invest in stocks year after year after year, we will link the returns this way. And then it's a 1 plus R annualized return. And here's a specific example. So here we have the 2004. Okay, 2004. If you look at here, it's a 0.9982. So that's from here. Because here you have this dividend and this capital loss because this number reduced. So you have a little bit capital loss and some dividend yield. The total would be a negative 0.18%. Plus 1 is a 1 plus R, right? You get a 0.9982. And this number is a plus 1 is a 1.1182. And you link together because you have three dates here. You link these two together, three together minus 1. That's annualized return. And whereas for 2008, we have 4 periods here. So we chain link them. And this is what we get, the annualized return for 2008. So that's how we calculate annualized return. So we have 4 quarters, okay, 4 quarters. That form a year, okay, and that becomes the annualized return. And what if you have year 1, year 2, year 3, year 4? Then it's called a holding period return. You hold 4 years. That's a holding period return. And here, the holding period is 1 year. 1 year includes 4 quarters. And here we look at the realized return for S&P 500, Microsoft, and T-bills. And we look at the T-bills is relatively, mostly between 0 and 5%. And Microsoft, huge swings. whereas SP 500 has pretty good swings as well. So the riskiness is this is considered a safer return. This is a riskier return. And if we plot this, so apparently the red is riskier and the green is less risky. So the average return for small stocks is 18.7%. For SP 500, it's 12%. So let's look at the one we get previous ones. Let's look at the previous ones. How many years do we have here? 1925, and the end is the 2015, or if it's 2017, 2017 to 92 years. So supposedly 92 years. That's what we get, 12% something. Okay. And here, if you look at here, it says the average annual return is 18.7%. This must be numerical averages, arithmetic averages. So you calculate the return for each year, and then you average those. The one we calculated is called a compounded return, or the geometric return. And here we go. This is considered a arithmetic return. So you calculate return for each year, you average them. And the variance is return less, so this is deviation, because each year you have an equal probability because historical. So 1 over t minus 1. This is considered, as long as you know, if there are t items, t years, right? If you know all t minus 1, then you know the next one, the remaining one, okay? Because this is a sample, so you lose 1 degree of freedom. And the volatility is the square root of variance. So here's the calculation if you plug in the numbers. So this is really nothing but the P, okay, the probabilities. And the volatility, you can see, is much higher for small stocks and increasing. So if you contrast the return and the volatility, you see a pretty good positive correlation. That is what we call the risk-return trade-off. And using past returns to predict the future is problematic because the future may not repeat the past. And here we calculate the estimation errors using standard error. Standard error is the standard deviation divided by number of observation square root. So here 95% confidence interval is plus minus 2 standard errors. So if for 19.8% divided by the square root, this is standard error 2 times this. So the standard error would be 2% or so, right? So so in this case, if we do the SP 500 return, the within 2 standard errors, the range is 8 to 16%. So it's pretty big range still. And this slide, we look at the accuracy of expected return estimates. And we look at specifically, we look at the 95% confidence intervals. And here we'll look at the average return 10%, okay, 10%. And volatility 17%. The standard error is, so how do we calculate standard error? Standard error is a standard deviation. So standard error equal to standard deviation over, this is n, okay? So you have a 17%. And here, how many years do we have? 12 years, square root of 12. So this is if you divide it, it's 12. It's roughly 3 something, right? 3.5, let's say. So divide by 4 is 4, divide by 3 is 3. So this number comes out to be 4.7%. So that's a standard error. So 2 times this number. So the confidence interval would be this. And with just a few years of data, it's really hard to estimate the returns. And here we look at the return and risk trade-off. So risk is higher, your return, so it's compensated by higher returns. And excess return is the difference of the return with the T-bills. Okay. We also call this a risk premium. And in this chart, we plot the return against volatility. So if we look at this return dimension versus this risk dimension, so higher risk, higher return. So higher risk, higher returns. Lower risk, lower returns. The returns of individual stocks, there's really a positive relationship between risk and return for large portfolios. But how about for individual stocks? It's very hard to say. There's no precise relationship. Larger stocks tend to have a lower volatility because they are less risky. And all stocks tend to have higher risk and lower returns than large portfolios. So the lesson is to form a portfolio to reduce risks. And here you can see all of these stocks are the independent stocks. And these squares are the portfolios. Okay, portfolios. So now the question is, are we going to be compensated for holding individual stocks? So the answer is no, because in a diversified portfolio, only common risks matter, whereas the independent risks will offset each other and diversify away. And the common risks are, let's say, market risk, interest rate risk, and foreign exchange risk, commodity risk, etc. Whereas the independent risks are firm-specific. And firm-specific versus systematic risks. Firm-specific news could be bad or good. Bad news for one, maybe it's good news for another company. So they tend to cancel out each other when formed in a portfolio. The market risk is related to the news that influences all stocks. And independent risks are also called firm-specific risks, idiosyncratic risks, unique risks, unsystematic risk, diversifiable risks. So these are just different terms, but the same meaning. And the common risks are also called market-wide risks, systematic, undiversifiable market risks. When many stocks are added into a portfolio, the firm's specific risks tend to be averaged out. However, the market risk will remain. We'll look at when we add more and more stocks into a portfolio, we'll look at the risks, if the risk of the portfolio will reduce, and at what point. So the question is, how many stocks do we need to hold in order to diversify away the risks? So keep that question in mind. We'll come back to it. Consider these two types of firms. S, only affected by systematic risk. I, affected only by firm-specific risks. So here, the actual firms are affected by both risks. When firms carry both types of risks, only the unsystematic risks will be diversified away, and the market risk will stay. So here is a type S, because you cannot diversify away the risk. Whereas the type I, the risk will be diversified away. So when you add more and more, see, when you add 10 stocks, the risk reduced dramatically. And when you add 100 stocks or 1,000, so really you don't have much risk anymore. Portfolio volatility. So what's the volatility or average return of 10 type S firms? How about 10 type I firms? So let's look at that. So type S firms have equal likely returns, positive or negative, and the expected return is 10% here. So standard deviation of that is 30%. Okay, this is P deviation squared, P deviation squared square root. Because all type S firms have high or low returns at the same time, the average return of 10 type S firms is also this. So the same volatility. Whereas for type I firms, it's equal likely to have 35% or negative 25%. So we have an expected return 5%. The standard deviation for one return is something like this. However, the returns of type I firms are independent. Then the average return of the 10 type I firms has volatility of, because you have 10, right? So you need to use 30 divided by square root of 10, so 9.5%. So relative to the one stock portfolio, 30%, if you have 10 stocks, reduced to 9.5%. If you look at its chart. So if you have 10 stocks. Similarly, you can have 100 stocks. That will be 30% divided by square root of 100. So this is 10, right? So this reduced to about 3%. So if you look at here. So that's 3%. Okay. And here is nothing but 10%, right? 30% divided by square root of 10. So really, this is roughly 3. So 10%. Okay, roughly 10%. No arbitrage and the risk premium. Because risk premium for diversifiable risks is 0. That means, if the risk can be diversified, then you really not paid for holding that risk. And the risk premium is determined by the market risk only. And the standard deviation is not an appropriate measure of risk for an individual security. And there should not be there is no clear relationship between this volatility and average return for individual securities. So to estimate the securities expected return, we need to find a measure of the securities systematic risk. So basically, we have the risks. So for a specific security, so there are two components. There is a market risk, and there is a firm-specific risk. Okay, firm-specific risk. So two types, and this will be a diversified way. We need to find out this component. And that's a Nobel Prize-winning theory called capital asset pricing model, and the term is called beta. So let's look at the types of risks, diversifiable versus undiversifiable. The risk that founder and CEO retires is a firm-specific risk. This can be diversifiable. It's diversified. And here, oil price, that's market risk or systematic risk. And product design is 40, it's diversifiable. And economy, so that's from market risk. And how do we measure systematic risks? To measure that systematic risks of stocks, we need to determine the variability of its return relative to the market. And we define efficient portfolios as the portfolio that contains only systematic risk. And there is no way to reduce the volatility of the portfolio further without lowering its expected return. That means for the same risk, the return is highest, so that it's efficient. Okay, that's why it's called efficient. And the market portfolio is a efficient portfolio that contains all securities in the market. But in reality, we use proxies. We use SP 500 in US for the market portfolio. And to measure the systematic risk, we introduce a new concept called beta. Beta measures the sensitivity of a stock's return relative to the market return. So essentially, it's if you have the stock return, and then you have the market return, and if you have this plot, that's a slope. This slope is what we call a beta. So that's the sensitivity of the stock return relative to the market return. So these are the interpretations of the beta. So how do we estimate beta? Suppose market portfolio increases by 47%, decline 25%, and the beta for type S firm, whose return is 40% on average, and the portfolio is strong, and negative 20% when the economy is weak. What is the beta? Right? And then what is beta for type I firm? So we look at sensitivity of S relative to the market. Okay. Let's do that calculation. So the systematic risk of the strength of the economy produces this much change in the return of a market portfolio, whereas type S has a lower change, so the beta is this much. So if you look at the slope concept, it will be easier to understand this. Okay. So you have a negative 24%. This is market. Okay. Negative 25% and positive 47%. And then for the stock S, this is a type S, you have 40% here and negative 20% here. So 47% right there. And here negative 20% right here. And that's the other point. If you look at the slope, would be so this is a delta change in y. Change in y would be 40 minus 20 is 60%. So delta y is 60%. Delta y is 60%. And this delta x is just 47 minus 25 is 72%. So delta y minus over delta x, that's your slope. Slope, okay, equal 72 over 60%. Okay, and here would be simply no, let's say it's a delta y is 60 and here is 72. Okay, and would be 0.833. So it's a slope concept. Okay, for type I, you see that beta is 0 because the type I has only firm-specific risk. So it's not affected by the strength of the economy. So its return is unaffected by the market, and it will have the same expected return no matter the economy is strong or weak. So it's no change. So delta y is 0. Beta. And beta is related to the market risk premium. And the market risk premium is the difference between the market return and the risk-free return, rate of return. So for market portfolio, the beta is always 1. So that's by definition. And then if the return, if the asset is higher, has higher risk or lower risk relative to market, so we always use market as a reference. And for the risk-free rate asset, the beta is 0. Okay. So for risky assets, so we will get a risk premium in addition to risk-free rate of return. And the risk premium depends on how sensitive the assets return relative to the market return. So we adjust the market risk premium by beta. So this is what we call the capital asset pricing model, the most important equation in finance, one of the most important questions. But it's not easy to estimate this number. Okay, so I would encourage you to estimate beta by downloading some pricing data and calculate returns for certain stocks relative to S&P 500 from Yahoo Finance and do those calculations and see if you can get a beta that is similar to what's reported on Yahoo Finance. So as expected returns on beta, suppose risk-free rate is 5%, and the economy is equally likely to be strong or weak. Use this equation to determine, so basically we are going to use this equation to determine for the cost of capital for type S firm. And here we have the market return, 11% market return. And the market risk premium is difference between the market return and the risk-free rate return is 6%. And given the beta for type S, so we calculate, plug in these numbers. We calculate the return for type S firm is 10% lower, slightly lower than the market return because it has a lower beta lower than 1. And this matches the expected return of this one. So supposedly it's the same. Okay? So this is the same. So investors who hold these stocks can expect return that compensate for the systematic risk they are bearing. And that's the end of this chapter. And there are a lot of calculations. I would encourage you to practice and practice. So the only way you master this concept, these concepts is through calculations and practice, and then understand the true meaning behind these concepts. Thank you.